Let's get rid of that. Access to this webinar is for educational and informational purposes only. Consult a licensed broker or registered investment advisor before placing any trades. All securities and orders discussed are tracked and monitored in virtual trading accounts. Virtual account prices and returns may differ from actual trading results. Commission costs are excluded. Neither PhilStockWorld.com, PSW, nor its affiliates, nor any of their respective officers, personnel, representatives, agents, or independent contractors are in such capacities licensed financial advisors, registered investment advisors, registered broker dealers. Nothing contained in this webinar, website, or promotional material constitutes a promotion, recommendation, solicitation, or offer of any particular investment security or transaction. Trading options involves risk. Visit the OCC website, www.optionsclearing.com, to read characteristics and risks of standardized options. PSW provides educational and training services that are meant to teach you the risks and potential rewards of trading options, and we are not a service that tells you what to trade. We are not implying or guaranteeing any profit. As always, do not trade with money that you cannot afford to lose. Past performance does not equal future results, and the results discussed in this webinar are not typical and are only valid on that specific or identified date. Your results may vary. By accessing the webinar, you agree to wholly but harmless. Many losses you incur as a result of the information discussed in the media identified above. By accessing this webinar, you agree to be placed on our mailing list and receive our newsletter. Rest assured, we take your privacy very seriously. We will not distribute or sell your information to anyone. Yay! I'm like Mark Zuckerberg, right? Wow. This is Adam Sandler movie where it's, I forget what it is, like he has 1,000 words left to say in his lifetime. So he has to be real careful about what he says. It just drives me crazy, like reading this thing every single time. It's like so many freaking words. Actually, this whole webinar, though, I mean, God, 2 hours of me talking is just crazy. I mean, it's the most I talk all week. You know, when I'm on the phone on meetings and stuff, I try to like get to the point and be done with a meeting, you know, not like go on and on. All right, so where are we? Market. Let's see, we can bring up the chart here. What's that? That's not what I want to see. Charts. There we go. And as usual, we're recovering off the lows, getting ready for the Fed meeting, which starts in an hour. And we will see what happens there. But obviously, everybody's expecting them to lower rates another quarter point. If they don't, they'll be disappointed. Somebody pointed out today, it was great. Twitter. Because we got the GDP report today, and that said that, what is this? Is this Twitter? PBS Twitter. It's an image from Twitter, but it's not Twitter. I lost Twitter somehow. TWITT, Twitter. Who was it? Carl Cantoni, I think. Carl Can. Is this him? No, Carl Cantia. The guy from CNBC. Carl Cantonia, CNBC. Damn it. Oh, well. I'll just tell you, he posted an old tweet of Trump's that was, I can't believe I can't find it. It was an old tweet. It was funny because it was an old tweet of Trump's. I should have retweeted it when I saw it. And it said, here's Trump tweeting the greatest economy in history. I gotta find it because there's this old tweet of Trump's where he says we had when Obama had a 1.9% GDP, and he says that we're in desperate trouble. This economy sucks. The exact same GDP as he got today. Carl. Hey, wait. That guy. Oh, Quintonia. No wonder I can't. No wonder I don't know what it was. Aren't you the guy that did it? Now watch it not be him. Oh no, here you go. That's so funny. I gotta retweet that. So, wait, how do you do this? So in 2012, Trump tweets, Q1 GDP has just been revised down to 1.9%. The economy is in deep trouble. And now, today, he's on a 1.9 GDP, says the greatest economy in the history of America. So, you know, beauty is in the eye of the beholder these days, right? It's too funny. I don't know. I don't know what to say about that. It's just crazy. Anyway, so we have stuff to talk about because now we have portfolios again. We haven't had them for a while. Been a month. We had a month off from having portfolios. Already in our dividend portfolio, we have 5 stocks and a short put. Here's the point. I said in the I was saying in the member chat room, the dividend portfolio, just because it's a dividend portfolio doesn't mean you have to buy stocks to get a dividend. You can sell a put just like any entry we like to make. So I looked at Pfizer, and it's a big commitment. If we start buying Pfizer shares, you know, we're assuming this portfolio that we have 200,000 in buying power. So this is based on like an IRA. So it's saying that we only have 38,000 cash on hand. There's no margin in the account, and it's giving us a buying power of 21,060. So we really have a buying power of more like 121,060. But the bottom line is we have used $64,000 of security cash plus $17,000 in margin in this portfolio so far. All right, so that's 64 and 17. So we've used the better part of half of our potential buying power for these positions. And, you know, as they stand, they're going to return probably about 20. They're going to return something like $40,000 over 2 years, so 20% a year, which is our goal for this portfolio. But we are going to play it more aggressively and use a good portion of $200,000 worth of buying power. You know, as any normal account, not an IRA account. Of course, if it's an IRA, you have to stop here and take your 20%, but at least it's tax-free. But if you have a taxable account, you want to make more money, so we're going to push it a little bit. But anyway, the point being though that we would have tied up a lot of extra money, and our goal on Pfizer, we'd have to protect ourselves because we don't want to risk it. It is a risky stock; it can go up or down. So on the whole, we said, you know what? It's not really at an optimal place at 38, but we could sell the 35 puts for almost $4 for 380, and that brings our net entry down to 31.20, and that's the price we definitely would like to own Pfizer. I'm willing to pick something else to sell. I would sell Ford, and I would probably sell, I guess Signet maybe if I felt that I could, you know, have a good price on Pfizer. You know, I wouldn't mind getting rid of those two and raising some cash. So, you know, I like it a lot at that price. Then I make that a nice key position in the portfolio. But as it stands now, I just think it'd be nice if it comes down. So we just sell the put. It's as much money is more money than the dividend would pay over the course of 2 years. So if we never get the stock, we still get the dividend as if we did own Pfizer. And otherwise, we'll just wait and see what happens. But there's no reason not to do that in a portfolio. Just because it's a dividend portfolio, we can still sell a put against a stock to give ourselves a nice buy entry if it ever goes lower. If it doesn't go lower, we keep the cash. We picked up Ford, of course, and this is only since Friday. So from Friday, we're already up 2.6%. That's crazy. This portfolio's goal is to be up 20% for the year, and we're up 2% in less than a week. That's a pace of 100%. It's not possible that we'll be up 100%, obviously, because the positions have a definitive payoff. We went through those numbers yesterday in the Morning Post. There's no intention of that. We just happen to have a couple of good breaks that are pushing things in our favor, but that doesn't really mean much at the moment. So we'll see what happens. But we have the Ford position here, and Ford's at 850, and we're playing it to be above 7. These are very conservative, right? So we have a lot of leeway there. We have almost 20% downside before it's even out of the money for us. Annaly Capital also, it's also $9, and we're playing it to get called away at 7, but we do have the $10 put, so we're playing it really to be at 10. Okay, but we have a very, very aggressive put sale on it because we feel it's very undervalued. Signet Jewelers, we're playing it to come to call away at 13. It's almost at 17, so it could drop $4. We're still in the money. Tangier, fortunately, we played it to 15. It was 17.15 yesterday, but we sold these $15 calls. We sold the $15 puts. We lowered our base significantly from 17 minus 6 about, so call it 11. So our basis is 11 on the stock, and we get called away at 15, and we're still at 16.25. The reason, though, is they just paid a dividend. That's not reflected here. It's only, it's like 35 cents. So basically, they paid us $350 today because we owned the stock yesterday. Because it's the shareholders' record at today's close. So we get a 35-cent dividend that's going to drop $350 to the portfolio, which is what the dividend portfolio is all about. And unfortunately, since holders' record goes by the morning, people dumped out the stock. It's very interesting because a lot of people were holding on for the dividend, and then this morning there was a massive dumping. Let me see if I can show you. Look at that. So at the close yesterday, right, completely dumped down. We came in at about here, 17.15. It drifted lower. People sold it off into the close. And then this morning it opened way, way down. It even touched 16. So I wish we bought it this morning. But what can you do? You know, we're not really sitting around trying to optimize those trades. We just sort of, you know, I mean, the point is to learn how to treat the dividend stocks and how to play them over time. And AT&T, of course, this is our anchor position because it takes up a big chunk of money in the portfolio, about 36 minus roughly 28,000 in cash on this position. So it's almost a quarter of our total cash in the portfolio is in this stock because we think it's a good long-term steady stock to hold, and we're happy to make that the anchor for the portfolio over the long haul. And here we sold the 35 calls, which brings us down to a good 10% lower than it is now, and the $30 puts, which are 20% lower than it is now. So we have a long, long way to go before this position could be in any trouble. And that's what it is. We just picked up very conservative positions. We're still kind of worried that the market's going to correct at some point, but it's a very simple concept. And already we got our first dividend from Tangiers. We're going to get 1, 2, 3, 4, 5 dividend checks each quarter. And I'm not sure what the amount's going to be, but let's say roughly let's say if we have 350 from Tangiers, we're going to get from AT&T 5. That's probably about $3,000 a quarter in dividend checks. That's not bad. So 12, you know, we pick up 12,000 a year in the dividends. That's 12% of the whole portfolio already, plus any appreciation on the stock. So if we get 12,000 on the dividends and 10% on the stocks, that's you're over 20% already. And that's what we look for. And by the way, you know, as the dividend positions improve and mature, these are long-term spreads. So we have value in these positions. We will be able to sell short calls against the positions. Not a lot, but, you know, somewhere in the neighborhood of like 2 to 4 short call contracts. But that provides a tremendous boost. So if we thought AT&T is toppy, frankly, at 38.39, if we think AT&T is toppy, we can go ahead because we have a position that's going to pay what did I say this is 31,000. So we're gonna get 35,000 back. There's a $4,000 profit on anything over 35. So that's our cushion against which we can sell short calls. We know we have a $4,000 upside cushion for getting the dividends, plus we're gonna collect dividends. So if we want to enhance that, we go to T and we look at the options chain. And let's say January. Usually you want to go about 3 months when you're doing sales, because that's when you're going to get the optimal amount of premium. 1 month is, well, first of all, it's tedious because it means every month you have to keep selling. And second of all, you get a smaller amount, so you don't have as much cushion. So I prefer to do a 3-month sale. you're only getting double what you would get in 1 month on a 3-month sale. Well, you have to keep that in mind also. So, but let's say, for example, I don't want to go yet, but if we get to 40, let's say, and we can sell these $40 calls, which are currently 52 cents, and notice the delta is 54, so this is the correct amount. If it moves up $1, these should move up 50 cents. If the price goes up $1, that's what the delta means. For every dollar that AT&T goes up, I'm sorry, that's not the delta. Silly me. The delta is 28. That's the last sale price. So for every dollar AT&T moves up, the option should move up 28 cents. So therefore, if AT&T moves up $2, I should get 56 more cents, and we're going to be right at $1 basically on that. So if we hit 40, this option should be $1 with 40 calls. Now, if we then turn around and sell, we have 10 longs. If we sell just 2 of them for $200, I understand it does not sound very exciting, right? It doesn't even sound like it's worth doing. But if you think about it, if we sell 2 of them every quarter for $200, it's $800 more we're going to pick up over the course of a year. That's $1,600 we're going to pick up over the course of 2 years. Just selling 2 contracts for $1 each. For $1 per option. So if every quarter we do that for 8 quarters and we pick up $1,600 more, that's going to increase the returns on AT&T by like 20%. That's huge. That's, you always want to do, not 20, I mean 20% is going to increase the amount of the returns by 20%. The amount against the stock investment will be about 5%. So we're going to add 5% to our returns. But why wouldn't you want to add 5% to your returns? It doesn't make sense not to add 5% to your returns when you can. What's our downside if we sell the short calls? Well, what if AT&T goes to 45? If AT&T goes to 45, we would owe our option contract people back $1,000. But on the other hand, our long positions will be deeply in the money and will be in very good shape to collect our $4,000. So we're risking 1,000 of the 4,000. It's not likely, obviously, AT&T goes up $10 before we're able to react. But, oh, and by the way, we also can roll these to longer, higher strikes. So even if AT&T does jump to 45, well, I'll show you. Where do we find 45? You see these 45s are 76, right, in January 2021? So we will be able to roll, if we're wrong and we get burned, we'll be able to roll these guys, which are 52 cents, up to the 45s, which are 71 cents, really to the 47s probably by that time, and up to, in fact, in 2022, up to the 40, maybe up to the 55s, or at least to the 50s. So we have a lot of headroom to roll to. It's not that likely we're going to take a big loss. And even if we do, the loss will be $1,000 compared to the $4,000 we're gaining on the stock, plus another $4,000 we're collecting on dividends. So the risk is 1/8 or about 12%. So the risk is 12% of our projected gains. But the only reason we lose 12% of our projected gains, I'm talking about $1,000. The only reason we lose $1,000 is if AT&T popped up past 45. And if AT&T popped up past 45, this position becomes very, very safe. Because our goal is, I think, 35 on the position. So the trade-off is we lose 12% of what we thought we were going to gain on AT&T, but we are now deeply in the money, and it's a position where we'll be able to move on and buy something else and just say, forget about that one. We don't have to worry about it if it's so far in the money. Or maybe we'll even get to cash it in early and recycle it and put it into something else and make even more money. So there's not really a terrible downside to selling a very small amount of options. But if you do it and it returns to you an extra $800 a year, in a $100,000 portfolio, that one position right there, that one extra effort we make is going to bring us in another 1% on the portfolio at the end of the year. Not to mention, obviously, giving us better insurance on the AT&T position, if it goes down. So there's no reason not to do it. It's a very simple strategy to enhance your returns. And then obviously, if you think about it, if you had 5% better returns on all your portfolios for your entire life, would you be better off or worse off than you are now? It's not a complicated thing, right? See if we have any questions. 1020 said, good morning from Smoky, California. Yeah. What's cooking 1020? Phil. All right, Wayne says, Phil, you cashed out in September thinking the market risk was 5 to 10% down. Now you're retaking long positions. Have you changed your premise? Has the S&P broken out in your opinion? Good question. Good question. Oh, thank you, 1020. He even knew who Carl Quintanilla was. Well, you guys are so on the ball. All right, let's get to that one. Let's get to that one in a second. Abel's asking about Ian Enbridge for the portfolio. We'll take a look at that. Alice just says, how are you going to account for the virtual dividends within the portfolio? Since they are only virtual, therefore the portfolio, they won't really receive the dividend, but the tracking system I use, which is Power Options, allows you to book a dividend. See this position actions, and it says add dividend, and then you tell it what dividend you received. So that works. So basically, once it gets logged in officially as a dividend and people get paid out, we log it in here also. So yeah, we do keep track of that. Otherwise, it wouldn't be any point to keep a dividend portfolio. Let's see. Okay, so what was that question? Oh, how do I feel about the market? All right. I wrote about this today, actually, Wayne. So frankly, you're being very lazy if you haven't read my article. Making me explain what I wrote. But here you go. Let's see. I said, we wanted to get a cash at the end of September because they had done very well. We didn't want to risk getting into earnings, Brexit, China trade, Mideast unrest, impeachment, and what looked like a slowing economy. And today we just found out the economy is slowed to 1.9% GDP. Oh, in fact, let's see what the Atlanta thing looks like. GDP now. How that works? GDP now. Now, GDP now. What am I doing wrong? GDP. How about if I just do that? There it is. There we go. All right, so here's the Atlanta Fed's estimate of the GDP, and it has gone lower since here. It was once upon a time, they were looking at, that's for this quarter. So since they only start in July forecasting what the third quarter is going to be. And so in July, they started off at 2%. They were getting enthusiastic in August that it was going to be higher. They lowered it all the way down to 1.5% at one point, went back over 2, and now we're at 1.9. So, you know, generally nobody ever thought it was really going to be very strong. There was a tiny brief period where kind of people are enthusiastic during August, but then it calmed down again. So there's not really a surprise that we're at 1.9. It's just unfortunate that we haven't managed to beat it. So all the things I was concerned about in September, this is sort of a non-event. I'm not shocked that the GDP, we were making fun of the GDP forecast anyway, saying how could we have this, how could we be saying it's going to be over 2 when you've got all these issues? And aside from the trade, you have all these, the consumers are getting less confident, and the Fed reports are coming in weak. beige book is showing the people, the purchasing managers are worried, the purchasing managers index is down. So many things are down. You're like, how can we possibly have a stronger GDP than expected? I think the problem is, though, the fourth quarter GDP isn't going to be good either. And that's something nobody's really priced in yet. But for now, we're worried about the third quarter. So the third quarter keeps getting revised down. So back to what I was saying. So GDP, or let's just say slowing economy. Slowing economy, all right, nobody seems to care. I could be right that the economy's slowing, but I'm wrong about anybody actually caring or saying, well, gee, if the economy's slowing, maybe these companies will make less money. Not really a consideration. What's happening instead is that the multiples for earnings are just hitting all-time highs. People are just paying more and more money for earnings. It's really crazy. Same thing goes to the impeachment. Clearly, Trump is going to be impeached. There's no question about it. I mean, well, I'm sorry, if you watch Fox News, you probably have questions. But if you don't watch Fox News, if you have an unwashed brain, then Trump is going to be impeached. There's no, it's open and shut. It's just only Johnny Cochran could get Trump off at this point, and he's unfortunately dead. It would be as shocking as OJ getting off if Trump gets away with this thing. Then we've got the Mideast. Well, that got way worse. Well, us withdrawing from Syria completely destabilized the Mideast. The Arabs, we were worried about the blockade in Iran and the sanctions. Nobody's even talked about them since September, because since that time we had a couple of ships blowing up in the straits, which hadn't happened yet. We have had an attack on a refining facility in the Mideast where it actually was bombed and had to be shut down and put back online and so on and so forth. And we've had Trump withdraw from Syria and completely destabilize a major oil producing region in the area. Nobody cares. No one cares. It makes you wonder why we ever cared. Why did we ever bother getting involved in the Middle East? What does protecting oil mean? We're not protecting anything. It's just complete chaos. I mean, it doesn't seem to matter. Then China trade, maybe we're going to have something signed by the 17th, maybe not. The White House currently says it's still on track, even though now we don't know where we're going to meet and how we're going to sign it, because we were going to be in Chile, but now they're having riots in Chile. Why are we having riots? Because economic inequality is outrageous, and people are getting pissed off, and they're rioting in the streets all over the world. The people are rising up. Nobody cares. Doesn't matter. So again, what are we supposed to do? It's like we have money. We got to do something with it. We may as well invest it. You have Brexit. Brexit's always fun. Brexit has been put off now until, I forgot, January 31st, I think. And it doesn't really matter, does it? So that's another thing. That it'll happen when it happens, and nobody seems to care. Even though Brexit may be a cataclysmic risk to the global financial system and may cause the euro to collapse, and not immediately, but I mean, just England pulling out of the EU is going to destabilize the euro for sure. For sure. Now, the instability, though, of the UK leaving is that they do contribute quite a lot of money to the eurozone. Every country contributes into the eurozone for the common good. If you take the UK out, it doesn't make it cheaper to run the eurozone. It's not significantly cheaper because UK isn't playing anymore. They were the second largest economy in the eurozone next to Germany. It's Germany, UK, France. So now they're not contributing, and now the question is, even if Germany disproportionately picks up half of the excess, then now they have to spread around the payments that the UK used to make to the other countries. And they are not going to be happy about that, and that's going to impact their budgets. And then there's all these rules in the EU about how much of a budget deficit you can run, and they'll have to cut back on other things, and so on and so forth. So eventually, a weak economy country like Portugal or Italy may say, you know what, screw you guys. This is BS. It's like it's like a club where the dues paying members have to pay to keep the club running, and one of the biggest members leaves, and all of a sudden everybody else is being asked to pay more, but now one of the biggest members isn't even there anymore. You know, so all the smaller members start going, well, what are we doing now? Now it's really just Germany and France's thing. And it becomes more unbalanced because now more so whatever Germany and France say goes. There's only really two countries with a serious voice in the EU. In fact, France was the one who was holding up the Brexit. They weren't holding up, they were holding up the extension because Johnson wanted an extension, and France was like, no, you're not getting an extension, get the hell out of here. You know, Germany talked him out of it, but France's attitude was like, get this thing done already. It's driving us crazy. So anyway, so you know, just think about what's going on from the point of view of the smaller countries. It's like this is killing them, and now they're in this thing, and they can't even trade with England, who's a major trading partner. They got to go make their own deal with England. They're paying more dues to the club for less benefits. Right? And it's the same club, and the EU saying, well, soon you'll be able to trade with Turkey instead of England. It's like, well, what? That's not the same thing at all. So it's a real mess. So anyway, so if Italy or Portugal or both or several other countries start saying, screw this and get out of the EU, it is very likely to just completely fall apart. And if it falls apart, the euro currency will fall apart, and that will be complete and utter global chaos because the euro is about 1/3 of all the money on earth, maybe about 28%, something like that. But it's a big deal because it's not something that will be easy to get around. So that's a pretty big risk. And the other risk was earnings. Now earnings are coming in a lot better than we thought. So the bottom line on earnings is that that's really where my willingness to come in is. It's like, yes, the valuations are very high, but by the way, the valuations are very high, but not on everything. We're going back into the stocks that have low valuations. We're going into the stocks that we think are still bargains. So when you say, did you change your mind? I didn't change my mind. We changed the mix of stocks that we have, and we changed the type of stocks that we're investing in, and we changed the type of plays we're investing in to be much more conservative. So this isn't about me deciding, this isn't about me deciding that I've changed my mind or my premise. I still think we've got problems. I still think we need a good 10% correction just to get to roughly the right prices, but I'm trying to pick stocks I think are already priced down, and even if they do go 10% lower, it's not going to bother me for a long-term hold. So that's what we're looking at now. If you want to know where I really feel about things in the short-term portfolio, which was right here, I think, right? This is the short-term portfolio. We only have 4 stocks. We have 4 stocks. We have a long on Freeport. Wait, I'll make that bigger so that nobody can see it. Okay. Oh, actually, sorry. Makes more sense to show you it on the actual portfolio thingy. There you go. Here it is. So in the actual short-term portfolio, whoa, 17%, that's pretty freaking good. In the actual short-term portfolio, Booking.com, which is the old price line, well, so, which was, okay, it's just the incorrect way to say it. BKNG. Booking.com, which used to be called price lines. It is price line still, I guess. So they've been a steady riser, and we thought they were getting a little toppy over here, so we took a short sale. And you know, it's a huge valuation, and their earnings are coming up on them. They haven't had earnings yet. Yahoo. Here we go. BKNG. No, that's not it. BKNG. There you are. Okay, so notice 90 times earnings. Okay, so I like them for short. I'm sorry, earnings per share is 90. Sorry, 2250 times earnings. Sorry, It's not terrible, but it's a lot for a travel company. And everything I've been hearing from the Fed reports and things is that tourism is down. Tourism is down. These guys are big in China, and Chinese tourism is way down. So I don't see how coming into earnings for these guys on November 7th, I don't see how they're going to beat. And they're priced to be constantly growing. So anyway, so what we took was we wrote 2,100 puts. It's a bearish put spread. We're buying the higher puts. We sold the lower puts, and this is for January 2021. So it's not right. It's not the one coming up. It's a year from January. And those are kind of our anchor against which we're going to sell other puts. So we sold the 1,800 puts of this year, and we sold the 2,000 calls. Now, one or the, obviously anything between 1,800 and 2,000, we make the entire, wow. We sold $40,000 worth of premium between, for January. So we did this in September. So for the month of September, October, November, December, January, 5 months. So for 5 months, we collected $40,000 in premium against a $17,000 net position. So we ended up with a $23,000 overall credit on the position, which means there's a lot of margin on this, but still it's very worth it. And if we get between 1,800 and 2,000 in January, we go ching and we keep the 40,000, and whatever's left on here is profit, and we're in fantastic shape. So that's amazing. Yeah, and already we're up, this is a mine, go say these two cancel, we're already up $13,000, $14,000 already. Oh, go away. Yeah. Do that. Okay, fine. Anyway, all right, so that's now the short-term portfolio. Don't forget our short-term portfolio is paired with the long-term portfolio, which has $500,000 all cash sitting around. I mean, don't forget we cashed in millions. We had 2-point-something million dollars, 2.5 million, something like that. So, but we're only reallocating 100,000 for the short-term portfolio and 500,000 for the long-term portfolio. So we're reallocating back to where we started the short and long-term portfolio 2 years ago, back to the original 600,000. But still, 600,000 gives us 1.2 million of spending power, plenty of margin sitting on the sidelines to do this booking trade with. It's only 2 short calls. And obviously, if we make $40,000 in 5 months, and that's 40% of this entire portfolio in 5 months, it's money well spent. So that's what we're doing with that trade. And of course, if we're wrong, we're going to roll the losing position out, and then we resell. So we would sell it. We can't be wrong on both. So if we're wrong on the calls, we're going to roll the calls to higher, longer calls further out in time. And if we're wrong on the puts, we roll the puts out to lower, longer puts out in time. And eventually, hopefully, we'll get the range right, and we will cash in. So eventually, we'll get the money with a pretty high degree of certainty. But it's a question of how long. So as long as you don't blow your margin and you can keep rolling, you can usually work these trades into a profit. It's just a question of how long profit. It would be fantastic if we get the whole 40,000 in 5 months. But if it takes 12 months to get 40,000 because we have to roll it twice, I'm still not going to cry about it. It's still 40% in 5 months. All right. Now, there's a risk, obviously, that we could lose some money and whatever, and it could go away. It could go up really fast, like Tesla did and burn us. But hopefully not. Let's put it that way. If we pick the right stock, it should stay range bound. So my theory on Booking is they're an incredibly profitable company. They're really good, but in this particular quarter, they're going to have a misstep with China that's going to push them back below 2,000 and probably keep them down there for a while. And that's going to be ka-ching for us. And that's what we care about. And it's going to be hard for them to come back and climb up. So I'm not worried about that upside. I think we're going to have a couple of sales like this ahead of us where we can make some serious money on these guys. So anyways, there's a bearish spread. So obviously I haven't changed my mind. I'm generally bearish. I still think there'll be a correction. If there's a correction, we win because this spread is 200 is 40. This spread here is $40,000. It's $200 times 200 contracts is $40,000, right? I'm not wrong. 200 times 200, 40,000. Thank you very much. Okay, so if that comes in, that's another $40,000. Don't forget, this was a credit to start. This is 49, so 50 minus 62, 72. So $22,000 credit was the start of this trade. And if booking ends up below 1900, we're going to make 40,000 on the puts, plus whatever money we make on other short put sales along the way and short call sales along the way. So you just literally in a portfolio like this, you can just make that one trade and have a fantastic year. If it works out. If it doesn't work out, you counted on something that didn't work out. Now, Freeport is different. Freeport, we're counting on that China deal to actually happen, but we're taking the 5-10 spread and the stock's at 10 now. So all it has to do is not go lower. And we're going to pick up the money on this one. In this case, it's a $5 spread with 10, so it's a $5,000 spread. Also for a net credit, a very small net credit on this one. So it's just a free $5,000 if Freeport hits 10. If they don't hit 10, we're going to own 1,000 shares of Freeport at $10. I'm not worried about that. That doesn't bother me at all. And obviously we would throw it, if that happens, we'd end up throwing it to the long-term portfolio. When we have one, we'll deal with it there over time. The marijuana ETF, now, we misplayed this last time because I bullheadedly kept thinking it would go up and it never did. The premise originally on the MJ ETF, which is my fault because I forgot about it, because when we went in up here, I said, well, the worst case scenario is we can keep selling calls and do okay. But what happened is they came down and I said, I think it's going to go high. We shouldn't sell calls until it recovers. And they went down further. And I said, I want to wait until it gets higher to sell calls. And it never went higher. Then I said, I think we should wait until it gets higher and we'll sell calls. And it never went higher. So now at 20, I'm like, screw that, we're selling calls. And I'll show you why. Because if we had sold calls, here we're taking the 15-30 spread. So it's a times 30. It's a $45,000 spread. We're paying, we're paying 21 minus 11 minus 12 minus 13, say. So we're paying about $8,000 for this spread. And in our first cycle of short call selling, we're picking up $800. And that's for, on 10/15, we sold the January call. So basically it's for 3 months. I would sell more if we had a higher price. If the stock were higher, I would sell 10 and not 5. But I still would like, I'm still waiting to see if 20 holds. If 20 doesn't hold, we'll sell 5 more. And if it doesn't hold, we'll sell 5 more. But over the course of the next year, 2 years, I expect to sell $8,000 worth of calls, which makes this a free spread. If we keep selling the calls and we sell $8,000 worth of calls eventually, this will be a free $45,000 spread. So it'll be just a nice bonus if it comes in. So that's the logic there, is that this should not lose money, because if you do have the discipline of selling calls, and we sure would have made it all on this one, because every single time it would have paid off. Ready to go. It would have paid off every time we sold the calls. Paid off, paid off, paid off, paid off, paid off, paid off, paid off. So even if that was only, even if we only sold like, let's say 1,000 every couple of months, we'll go 1, 2, 3, 4, about, could have picked up like $4,000 on the way down. You shouldn't lose money on these things because you should be able to get it back. I mean, and don't forget, we have 2 years to sell. This is only, this is not even 1 year. You should easily be able to get this money back, but you've got to have the discipline to sell and don't, which is exactly what I did though. I didn't have the right discipline because I kept thinking this would bounce. But it's been a lot weaker than we expected. Part of the reason is that a lot of the pot companies in Canada have overproduced and they're getting much less prices than they thought. They overspent because they got too much IPO money and they spent it and they wasted a lot of their money. And another part of the reason is that, well, they count on the American markets opening up, and it hasn't really opened up as fast as they thought. And there's one more thing, I forgot what it was. All right, well, whatever. And then they're not getting the prices they thought for the stuff, for the pot. So a lot of initial problems that they've been having, because Canada's a limited market, can't sell to their biggest potential customer, which is us. So it's a big problem for them. And most of these companies are named companies. Oh, I'm sorry. And yes, and another ETF came in called POTX, POTX, another marijuana ETF, and that drained a lot of money away from these guys. POTX, not available. Well, it's around. That's weird. Let's see what Yahoo says about them. Cannabis ETF. See, there it is. 1 year. Yeah, they just started, so it's not even registering on the other thing yet. And they're already down from 20. They're already down from 21 to 18. So they lost 15% in a month. I don't even know how they did that, because frankly, that's crazy. You know, still, eventually they'll make money. I see what these companies are doing. It's just, you know, look, eventually they'll make money. They got to sort it out. The industry is very young, and people overpaid. The funds overpaid because they began a fund, and their holdings are a bunch of marijuana stocks. Where are their holdings? Holdings. Equity. Oh, they don't have anything listed. That's why. It doesn't list their actual things that they have. But anyway, so these guys turn around and go buy a bunch of companies that are fairly new at high prices, and unfortunately didn't work out for them. So that's where we are. But my logic on this is saying, I don't care if it goes up or down. We can sell short call, short puts, make money, and not worry about what direction it goes. And that's what we should have done all the way along. So now we're kind of working on the assumption that it keeps deteriorating. Whoops. Sorry about that. So now we're working under the premise that it could keep deteriorating. We're going to keep selling calls and see how it goes. And then there's Tesla. And again, another one that we're generally short on. And here we sold the very long-term 202 to 250 puts. That's quite a bit below where we are now. And we sold the 340 calls, and we made already 77% on those. And we only sold them Friday. That's so funny. So we sold those Friday, and they're already up 77% because, you know, we sold them when Tesla was shooting up, and I figured 340 would be the top. And fortunately, I was right. Where is that? So, yep, how's that for a call, huh? So wait, this is Wednesday, Tuesday, Monday, and here's Friday. So Friday, when it was around here, we sold the 340 calls for $10. Could have gotten more money on Monday, but I didn't know it was going to go that. I didn't know we'd hit 340, but I said I can't see this thing going over 340. So we sold the 340 calls for November, for this month. So these are going to expire in 3 weeks, and we're going to collect all this money. I frankly don't even think there's a chance it's going to go back and go up again. You never know with Elon Musk though, but it's they have their earnings. The catalysts are all in. They've talked up China. They talked up their trucks. They talked up the factory. They talked up the batteries. They talked up the solars. I can't imagine what's left for them to talk about to get the stock any higher. So the calls came down a lot. The puts stayed where they are. Everything's hunky-dory at the moment. I'm more worried about the 250 puts, frankly, than I am about the 340 calls. But again, we're not done. We're going to. The reason we did this is the puts are so much more money than the calls. They're $26,000. So if Tesla goes up, I make $26,000 before I lose a dime on the call. So we're taking less risk on the call side, and it's the same thing because well, it's not much of it. You're not going to see it now as much, but TS, LA. So whenever Tesla goes up, what happened? Here it comes. So we sold the November, Why are you not moving? Boy, that's slow. Here it is. So we sold the 340 calls for 10. Now they're 250. And we did that on Friday. So it's a 1 month sale. So then next month in December, we're going to look to sell something for $10 also. So let's see right now. You can sell the 340 calls for $10 in December. I'm tempted to do that right now for $9. Why wait? I mean, I could, well, you know, what I could do is sell those for $10 and put a stop on the other ones at $5, and that way I lock in 5 and there. And then if I have to roll those in January, what's $10 in January? The 355s are almost $10 in January. So I'm not when I'm shorting Tesla at 340, it's not really 340, it's whatever I can roll it to. So here you go in March to 390s. So when I short Tesla at 340 in November, I'm not just saying I don't think it's going to be at 340 in November, I'm saying it won't be over 390 in March. So the next time, well, they have earnings in between. When they have earnings in January, the next earnings report that they have also isn't going to get them over 390. That's what I'm saying. They don't have another 20% in them to go up and burn me. And when I think that, understanding how the rolling works of my option contracts, I can always close that one and open another one for the same price at a higher strike and a longer date. Using that logic, I know I can do that. Now, if I don't get burned, then I can sell another $5,000 in December and $5,000 in January and $5,000 in February. Every time I don't get burned, I sell $5,000. If I get burned, I roll to a longer month, and all it does is skip some of the payments I get. But if I never get burned, and this is unlikely to happen, but if I never get burned to the upside, I get 24 sales of $5,000 each. That's $120,000 of short call sales alone on a stock that I didn't pay anything for it. Where I have my 26,000 of short puts, and if I keep selling, I'll have $120,000 worth of short call sales at $5,000 a month. All right, I'm not always going to sell $10. Sometimes I'll sell 9, sometimes I'll sell 8, sometimes I'll sell 12. But more or less, I'll try to sell about $5,000 a month of short calls. That'll be my primary goal whenever I can. If Tesla is extremely low, I may want to skip that month and not sell the calls. If it drops down hard and I don't like the prices I'm being offered for the short calls, I might not sell them, or I might take $5 for something still far out of the money. Or I might go to a longer month. It just depends on the mood. So it's probably, let's say we get half the time we get $5,000, still $60,000 to collect over 2 years. And again, this is only a $100,000 portfolio. We're talking about collecting $60,000. That's 60% of the portfolio. Plus, if the short puts don't go in, that's another $26,000. So, we're talking positions here on this $100,000 portfolio. It's just 4 positions that could very easily, this one's nothing, this one's $5,000. But, on this position, we're talking about $40,000. On this position, we can make $60,000, $80,000, let's say. On this position, we can make $45,000. That's 45. 60 is 140, $150,000, let's say, is a 150% profit on these 4 positions without the, just watching them go. So if that's my starting position, if that's what I'm capable of making on 4 positions, where we've only where we've got tons of cash on the sideline, not in the short-term portfolio, but in the long-term portfolio with tons of cash. Well, we have cash here too, because we net collected more money then we, if we have 150,000 cash on hand. Why? Because the stocks we have, if we liquidate them, will cost us $28,000 to liquidate. We have net negative value on the stocks because we sold a lot of short calls and short puts. But if those things start expiring on us and we collect $150,000, 150-cent profit. That's a nice way to set up a portfolio. And it is generally balanced. Our short-term portfolio, if you ever want to see what my real mood on the market is look at the short-term portfolio, because that's where I'll tilt one way or another. And this is generally a bearish portfolio. Tesla is aimed bearish. Booking is aimed bearish. The marijuana ETF is aimed for flat, not really aimed for bullish performance. We're looking for a lot of short call sales. And Freeport is again, flat. I'm just assuming that we're going to get a China deal at some point in 2 years, and that Freeport, the copper trading for Freeport will do better. Maybe, maybe not. But and again, you want to have something to a real upside position for balance. So that's how we begin shaping a portfolio. In the butterfly portfolio works all the time, no matter what. It just keeps grinding out money, because again, we're just and again, on that same premise that we just keep selling puts and calls constantly. So we don't even worry about that one. Dividends, we just looked at. Earnings. The earnings portfolio is the short-term plays. It's up 2.5%, and we only started that a week ago, so that's good for a week. And, again, you're tracking 100%. You're tracking for 100% gains. That's not bad. And the short-term portfolio, Hemboka is probably losing money still. 6.9%. Why? We were aggressively bullish on the MJ ETF and we got burned every freaking time. That's way back. That's an old trade. We've had this for a while. IMAX is doing okay. Molson Coors, not very exciting. And THC is our best performer. So we're down a bit on the Hemboka portfolio, but that's the only one we're losing any money on. And it's that old loss. It's exactly what I was talking about, the marijuana ETF. It just burned us because we should have sold more short calls, and we didn't do that. All right, almost time for the Fed. Abel wanted to look at ENB and Bridge. Let's see what they look like. ENB. Enbridge is priced at $73 billion. I didn't know that. I don't think I want to pay that for them. It says it's 50 times earnings. They do pay a 6% dividend, but dude, that's not. What are they making? What's the deal with these guys? Net income. Well, forget that. 2 billion, 2.8 billion, 2.8 billion. Sales, whatever. But for $2.5 billion in revenue, do I want to pay 73 billion? I mean, I don't see where they're getting 50%. 50 times earnings, but they're 30-something times earnings for an energy company. I don't see that. So no, my quicker answer to that is it's not one I'm certainly not exciting for the dividend portfolio. I want to see something with like really good ratio, like SU. Suncor is pretty cheap. Yes, see Suncor, much more reasonable. Okay, Suncor at 46 billion. Now they have trouble in the oil sands and things like that, but at least they're $47 billion, and they're making. Is this Canadian? Hopefully it's American money. Currency in Canadian. Don't be fooled. No, this is not as much as you think. But they're making $3 billion a year. See, but the problem is they have bad years. So if they have a bad year and oil prices go down and they start losing money, it's not consistent, and that's why you've only got a $46 billion valuation. And they're making $3.5 billion. They've got a lot of potential. But anyway, I like that a lot better than like Enbridge, where I'm paying like 3 times that much for earnings. That's just not for me. 1020 says we've been shot before, but he's toast. So I guess he means Trump. Ori says the webinar froze. Well, I don't know nothing about that. I hope it didn't freeze for everybody because we're about to look at the Fed. Yay. Oh, here it comes. Hang on. Let's put on the volume, see what they say. Down 0.25%. Rosengren and George dissented. No change in their assessment of the economy. They're lowering rates over global developments and the economic outlook. So they're saying the economy doesn't look that good. The global thing doesn't look that good. We're going to lower rates a little bit, but they also took away where they said they'll act as appropriate, and they're basically kind of indicating they're on hold. So let's see if we can find the Fed. I can't find it. That's okay. Hang on. I always like it when they parse the differences, though. It's better. So if I look for Twitter again, there we go. Go away. So this is not exciting for the market. Here's the statement. Here's your preview. Here's what the Fed will say today. What? See, he's wrong because they didn't say what he said. They said, I'm looking for one of these, but it's not going to be ready yet, I guess, from a legitimate news source, not Zero Hedge. Somebody who's actually read the statement first and is going to put down the changes. But anyway, let's take a look at what it says without the filters. Doesn't say much, that's it. The labor market remains strong. Economic activity has been rising at a moderate rate. Job gains have been solid. Unemployment remains low. Household spending although household spending has been rising at a strong pace, business and fixed investment exports remain weak. That has gotten worse. Well, they got that announcement yesterday. Yesterday, we found out it's really bad. On a 12-month basis, overall inflation, other than food and energy, are running below 2%. Market-based measures of inflation compensation remain low. Survey-based measures, long-term inflation. All right, so a little change. So I don't see any inflation, basically. Going back to this mandate stuff, the committee seeks to foster maximum employment price stability, economic outlook, muted inflation pressures. The committee decides to lower the rate to 1.5%, which is insane, 1.5%. This action supports the view that sustained expansion, strong labor market, and inflation, symmetric 2% objective are the most likely outcomes, but uncertainties about this outlook do remain. The committee will continue to monitor the implications of incoming information for the economic issue outlook as it assesses the appropriate path to the target fund rate. That's nothing, it's garbage language. In determining size of the future, the Fed committee will assess. Now, this is where they were saying that they will continue to foster the rates, but they're not. They're saying they will assess the realized and expected conditions relative to employment, and they're symmetric. Symmetric is interesting. That means that they don't want it to be over 2 or under 2. They want it to be at 2, which means as we get to 2, they are willing to go the other way and raise rates very quickly. This assessment will take into account a wide range of information, including blah, 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 including obviously economic data. So this is more or less a non-event. I'm not sure if the markets, let's see what the market's actually doing. Because we knew they were going to do this, but they're certainly not doing anything bullish. Holy crap. The hell happened to gasoline? We didn't look at that EIA report. That's the next thing we can do is look at what happened on the oil report, but holy cow. Gasoline fell off a cliff. When's the next holiday? Thanksgiving, right? So I don't know. I think if we get to 160, that might be a good long, going long on gasoline. All right, let's see if Twitter's gotten around to this thing yet. Oh, we're going to look at the EIA too. Get that on deck. We'll get this thing. Ooh, Japan is going wild. China's going wild. There's all kinds of. Isn't that weird? You can't filter Twitter for your own language. Well, what's the sense of showing me this? All right. No explicit hints in the statement as to whether another cut is coming, they say. Fed statement. Bloomberg says the Fed drops its pledge to act as appropriate to sustain the expansion. That's a really, really important point. So let's keep that in mind. Here it is. Thank you, Zero Hedge. So here's the actual thing. Now they see Zero Hedge did not see this coming. So what have they really changed? This is the most important part of the Fed statement. What have they really changed? July to September, okay. Okay, business fixed investments and exports remain weak. So they had weakened from the previous quarter. So from April, they had weakened. Now they just remain weak. So we haven't gotten any better. It's just sort of a downtrend. Nothing changed here, nothing changed here. The rate's obviously a quarter point lower. They used to say as the committee, blah, blah, blah. Okay, that means nothing. The committee no longer contemplates the future path of the Fed fund rate. It will, okay. So the committee, they used to say as the committee contemplates the future path of the rate. Now it says the committee will continue to monitor the implications of incoming information from the outlook. It will not act as it assesses the appropriate, it's funny how they try to keep words and make it fit, as it assesses the appropriate, no longer to sustain. So in other words, there's a big difference. They were promising to keep the rally going, and now they're not. I think this is a lot worse than they're giving it credit for, really, in the market right now. The path to the target for the Fed funds rate. So they will continue to monitor the implications of incoming information as it assesses the appropriate path of the target range. So in other words, we don't know what path we're going to take anymore. We are no longer promising you we are going to sustain the rally. We are no longer promising we are going to sustain the expansion. We are going to look to see what's appropriate now. So when you change from yes, Santa will, it has now changed from yes, Santa will of course give you presents tomorrow to, well, Santa's going to see what happens tomorrow. Santa's going to get some information. I'm going to look at the naughty nice list. I may or may not show up. That is not the same thing at all as, of course, Santa's going to give you presents. Okay, it's a big, big difference. It's not being taken into account right now by the people trading. It will be taken into account because what's happening now is people are having discussions like we are at the big hedge funds and stuff. They're all sitting in a room. This is the thing. This is why when you see those initial reactions, they don't mean anything. Because what matters is the serious investors who call a meeting with all their managers and sit down in a room and say, okay, what do you guys really think is going to happen now? What do we think this is going to mean and what's going to happen and how are we going to strategize moving forward? Oh, I'm running out of words. Voice is going. And nothing changed there. And Bullard preferred to lower, so now he got what he wants, so he's no longer objecting that we should have been lower. Now, see, that's interesting though. Bullard wanted lower rates. We got lower rates. Now he's happy. He's no longer saying we should have gone lower. Esther George and Rosengren preferred that the rates should be high. So two people think it should have been higher the whole time, and Bullard is no longer saying it should be lower. In fact, nobody is saying it should be lower. Two people say it should be higher. That's something to watch also. So that's where we are at the moment with that. Hey, Ori's back. Hi, Ori. See, I'm sorry that you were the only one, apparently. All right, Brian says CM for dividend trade. I like Canadian Bank a lot. It's one of my favorite bank stocks, but they're not cheap. So no. I'm just gonna quickly do that. If you want to talk about it, we'll talk about it in chat. But no, because it's not cheap. That's a real easy thing for me to say. That's not cheap. I'm not going to buy them. When they were down here, we bought them. When they're up here, we don't want them. The cut, CNBC, Federal Reserve Board changing the statement. Oh, thank you, Brian. Yeah, see, this a lot of people do it. It's easy enough to find. All right, so anyways, that's the bottom line with that. The Dow is pretty flat, I think, right now. Everybody's sort of like just sort of drifting along. So it's a big fat nothing at the moment. This was dollar, DX. And the dollar's not moving, and nothing's moving. It's all big fat nothing, and everybody's gonna have to assess where they are. That's it's so tempting to go long gasoline there. That's just an overreaction. Oh yeah, the EIA. Sorry, I forgot. We're gonna look at that. Where was it? Here it is. October 25th. That's correct. That's Friday. Okay. Plus. So what happened? Commercial crude inventories increased by 5.7 million barrels. Oh no. Gasoline inventories decreased by 3. Oh, that's okay. And distillate inventories increased by 1. So that's 6.7 up and 3 down is a net 3.7 gain. That's not good. You don't want to really see any kind of net gain. So, and then you want to figure out what happened if you can, because if they have a big increase in oil and a decrease in gasoline, it could just mean that there's the oil's backed up the refinery while they're making it. So there's always a transitional phase. And when you're making 21 million barrels a day of stuff, let's say that it's Thanksgiving and the refineries are closed for half a day. Well, they get the oil in and then they don't produce it and it gets backed up. And the next day another tanker comes with some more oil and there's a bunch of oil sitting in the refineries that doesn't get processed. That depletes the oil inventory, or that can then deplete the total stock of oil barrels, and then less output of gasoline that they convert. So there's a lot of different things that can affect the counts on these things. Just little thing like that, a half a day could have millions of barrels of effect. On the whole, other oils dropped 4 million barrels. That's interesting. So the inventory of other oils dropped 4 million barrels. Well, not 4, let's say 3. No, 4. No, it's more like 4. Overall, inventories have a drawdown. See, they don't count the other oils. When you look at the API report, they never count that. Actual oil went up 5 million barrels, yes, but motor gasoline down 3 million, distillate fuel down 1 million, all other oils down 4 million. So it's actually a net draw. It's really not bad. Gasoline in a nutshell was down. So why would gasoline be selling off? So there you go. Now we've decided. We held here at 161.3. So I would say that I would use the 161.5 line to go long with very, very tight stops below it. And hopefully we get down to 160. But so in other words, what I mean by tight stops, so don't be a hero. If you want to play here, what I would do if you're not good at stopping out and whatever, I would wait till the 162 line and use that. Because then you can use 162 with tight stops. But bullish here at 161.5 with tight stops below, and I mean tight stops like a half a penny below. Not half a penny, whatever it is, 1/100th of a penny. So very, very tight stops below 161.5. All right, that's what I would do right now as far as a long. But honestly, 162 is going to be a much better line. And if we're lucky, we'll get down to 160 and you can go long off of that line. And there I keep the stops a bit looser where I don't mind, a half a penny off is going to be $200. So, I risked $200 to hang on to it at 160 because that's, again, and I'm talking into Thanksgiving. So you want to play with like the December contracts. Oh, these are Z's. These are the December contracts. Yeah. So these are RBZ19. Keep that in mind also. These are December contracts. They expire next month and you get Thanksgiving money off it. But this is silly. It's an overreaction based on the inventory we see. That's how you play these things. The dollar's moving up. It's keeping pressure on oil. When the dollar stops moving up, we should get a nice bounce in oil. So that's our official play. That was easy enough. All right, so what else is going on? They're going blah, blah, blah about the Fed now as if it was like the most significant thing in the world, but it wasn't. They didn't say anything. I mean, they really did very, very little change. They did the rate rise you thought and everything else is the same. So I don't see much going on there. Ugh. Okay, all right. Long on RB at 161.5 with very tight stops below 162 is a better long line, or 160 if it gets lower. RBZ 19. Where are we? Futures, energy, hourly, gasoline. And that's how we end up making a play for PSW members. That's easy enough, right? That's a good one. I like that. See, and then if you see a trade like that, you say, well, what is it? It's UGAS or something that's ultra ETF for gasolines. And I think of how else could I play that? So you say UGAZ is 3 times, oh no, that's natural gas. Gasoline. UGA, it's only UGA. I thought there's something better than UGA to play. Okay, let's see. Gasoline Ultra ETF. I swear there's something. Top gasoline ETFs. UGA. All right. So now we know that we're going to stuck with UGA. We need to take a closer look at gasoline. So what happened last year at Thanksgiving? So here's November. Ooh, that's not good. Wow, look at that collapse. So gasoline really totally fell apart last year. In fact, look at this line here, 170. So it did not hold this line last year at all, and it completely fell apart. Although, like I said, 160 should be a good support line for at least a bounce. But last year, it collapsed, barely bounced off 160, and then went down. Now, by the way, when I say barely bounced, that's 165. 5 cents in gasoline at $420 per penny is a $2,000 move up. So that's why I'm saying I don't mind losing a little bit of money trying to play along here and then taking another poke at it here, because you're talking about a $2,000 win. So if I lose a couple of hundred here and a couple of hundred here, it's worth it in pursuit of a $2,000 bounce. But below this, forget it, because look at this epic collapse. Here's 150, a little bit of consolidation and down, then 140, consolidation and down, and 130. What happened to Thanksgiving? Here's Thanksgiving, I guess. It kind of bumped up here. Now, a dime move is great, obviously. So the weekend before Thanksgiving, of course, we go long on gasoline, no matter where it is, because that's what happens. But wow, I mean, it really collapsed out last year. I don't see that really happening now. We just had a draw. So we'll see what happens. And see, it's a big green spike yesterday. So we'll see how much this holds up. But that's crazy. Yeah, 167. See, we're holding up around where I said. And we'll see if that continues. So anyway, so how else do you play it? You can play it with UGA. But the thing about the futures is I can quickly get out and take my profit, even if it's only a couple $100 bucks. I can get the hell out and be done with it if it starts looking weak. Because again, it pays $420 per penny move. So if I get a quarter cent move, which we almost already have, that's $100 per contract gain. So $100, not that that's fantastic, but $100 per contract in like 5 minutes is pretty good. So you can just say, okay, that's nice. I made some money. I'm happy. I get to buy sandwiches tonight. UGA doesn't have long-term options. It's at 30 bucks, 30.80. What could we do in UGA? What if we took, so if we think gasoline is not going to be significantly below where it is now, we could sell the 31 calls for, it's on the way down, so probably get the low closer to here, so like 175. And what can we buy something for? Well, the 29s are like $3, so it'd be 125 for the $2 spread, and it's 75 cents upside. I don't like it. Now, see, there's not enough money in that. If it was an ultra and it had a faster movement, it was going to go more, you get more bang for your buck, yes, but I just don't like it enough to say that's a good bet. And I'm not getting 2 to 1. I like to get at least 100% return on my money if I'm going to make a bet like this, because it's almost a 50-50. So I don't like to get less. If you make a 50-50 bet and you only get 75 cents back on $1 on a 50-50 bet, then you're never going to win. You can't win. You're going to lose $1 or win 75 cents, and it's 50-50. You're eventually going to go broke. This is how casinos work. That's what they do to you. You don't realize it. Even if the odds are a penny against you, and if you win 99 cents and lose $1, if you play 100 times, you're pretty much going to have no money left, even though you think you're playing even. And God forbid a streak goes against you and you're totally screwed. That's the real house advantage in all these games. It's not so much the 1 or 2% odds that are in their favor. It's the fact that they can afford to lose 10 times in a row and you can't. When you lose 10 times in a row, you get up and walk away. When they lose 10 times in a row, they play another 1,000 times. And the odds tend to, over those kind of time frames, the odds are going to true up to them, and their 1 or 2% advantage always comes into play. But when you're playing, you can't sustain that kind of loss, which is where Keynes once said, John Keynes, the economist, once said, the market can stay irrational longer than you can stay solvent. Even if you know you're right. Like I know Macy's is worth more than it is right now. Even if you know you're right, it doesn't mean that you're going to be right in the amount of time that you need to be right. I like Macy's, but they are crazy on the break. Well, actually, they're not so bad as they used to be. What are they up to now? They're up to, what is this? What's wrong with this thing? Hello? Oh, that's weird. So Macy's is up to $15, and they were, well, not too much lower. Well, that's not 1 year. Yeah. No, they haven't actually been much lower. I'm sorry. So now Macy's pays a dividend. They pay $1.51 dividend. They shouldn't pay it, but they're paying it. Now, I'm sorry, $15 on Macy's is $4.6 billion. Macy's made, he said confidently, yeah, there it is, $1 billion last year. This year, they made That was last year. So this year so far they've made $200 million. But look at this. Well, their real money comes in next quarter. So they're still on pace for like $1 billion year. They're roughly on pace for $1 billion year. So, and you can buy the entire company for $4.6 billion, which is crazy. Okay, they have a lot of debt, yes, but they also have a lot of property, including an entire city block in Manhattan is their premier store. We'll see if they have anything interesting on that. Macy's. That. There it goes. Macy's Property Holdings. Yes, I meant Macy's. What did I write? Oh, really? For the Macy's real estate value matters more than ever. Blah blah blah. Is Macy's okay? Is Macy's real estate worth 16 billion? Net assets are not worth 21 billion. Macy's property portfolio alone is worth its market cap. These are my arguments too. They're looking at an 800-foot skyscraper on top of their store in Manhattan. Macy's real estate is first billions, but there's a few caveats. That's an much older article. So what is the value of Macy's real estate? Okay, as of July 31st, the Macy's was the fourth largest holding in the Scottish Investment Trust valued at what? What does that mean? I don't know what that means. I don't understand what they're trying to say there. I'm trying to see if there's a list, but there's not. Anyway, the world's largest story. This is an entire block from here to here and all the way down there, and that's an avenue which is really long. It's much more. There's probably 2 of these going back. It is gigantic. It is many floors. Their offices are up there also. They have, and what they're looking to do is to put another 10 floors above it, basically, and then rent out that property. They own, in New York, you own sky rights. You own the property above you own the sky above your property, and they have the right to build a much bigger building on top. How they would do that, I don't know, but you know what, in New York, it's funny because they do stuff like that, and I guess the value of New York real estate is such that it doesn't matter how much money you spend to build something. Like, there's things that you would say that's crazy because you would have to have these, you'd have to somehow construct a superstructure around the building that would support the additional building you're going to put on top. Because I very much doubt that this building can withstand the weight of another 10 floors on top of it. So what they'd have to do is sort of build supports and then build a deck on top here that would be strong enough to support the entire thing. And they'd have to somehow do that without sinking something right in the middle of the department store. You think they want a central support column or something. But in New York, you never think something's impossible because it doesn't. You think of something in terms of ordinary human scale, and if you know things about construction and real estate, you're like, oh no, that would be ridiculous. That would cost a fortune. It doesn't matter. In New York, what you think is a fortune, they're like, oh, come on, it's only $500 million to do that. And it's, but you're building a multi-billion-dollar piece of property. Anywhere else in the world, that would scrap a project. But in New York, they're like, yeah, of course, they'll spend whatever it takes. It's whatever it costs to build it. So yeah, they have a plan, they have a design, they have a cost factor already. They know exactly what they're going to do. And the great thing about New York is it's basically solid rock underneath everything. So, we have incredible, that's the other great thing about New York is it's a big rock. So they build these structures and they have very little problems. We don't have earthquakes, we don't have fires, we don't have all the stuff that plagues certain other cities in this country where you can't do good construction. San Francisco has a building that's tilting. It's like the Leaning Tower of Pizza. One of their biggest buildings is constantly tilting over because it's built. They didn't support it well enough into the ground, and the ground is shaky and it's caving on them. So that's the problem. And the tilt is like 2 inches, 3 inches, but that's very bad, especially in a place that has earthquakes. And everybody's suing those guys for the developers. But this is a massive, massive piece of land. I mean, just you walk around this place, you go to this store and you go shopping, you're exhausted from just all the walking around. Because they got floors and floors, and they got stuff up and down the block and all over. I mean, miles of walking before you're done with the store. And there's a basement too. Aside from that, they've even dug down. Oh, so they're saying they envision 355 apartments, hotels, offices, more retail space, blah, blah, blah. Now, if I'm a retailer, I would certainly like to be in Macy's. I mean, like, you know, the amount of people who come through this store every single day is astounding. You know, they're incredible drawer. In fact, there's a mall across the street just preying on the traffic that comes by Macy's. It's a gigantic mall across the street. So if they put a mall with destination shops and things up on top of their thing, a food court or something like that, I think it'd be really good. Anyway, that's just one property they have. Cowen puts a value at $16 billion. Somebody said $20 billion. So someday, anyway, they have a lot of real estate assets. This is their crown jewel. And they're saying, oh, if we spend $2 billion on expanding the property, it'll be add $3 billion in valuation, and also bringing significant cash flow, because the $2 billion will be financed over 30 years or 15 years, and the cash flow will be immediate, and probably they're saying apartments. So probably what they would plan on doing is recouping the money, the entire $2 billion from 335 apartments, which sounds like a lot, but let's see, $2 billion. Is that right? Yeah, $2 billion divided by 335, 6 million per apartment. Did I have that right? 5 million. Yeah, that's right. Okay, so basically they're looking at $6 million for apartments. I don't think they'll get $6 million apartments in there. So I'd say they'll probably recoup about half of their money from selling apartments, but also if they put up a hotel, that's another large chunk of change, and then renting the real estate. So cash flow wise, let's say they lay out $2 billion, and let's say they get half the money back from selling off apartments. They get another big piece of the money back from selling off, what was it? I forgot. The hotel. I'm sorry, the hotel. They get another big chunk from selling off the hotel. That means that they've now laid out, let's say, $500 million, but they're going to get the cash flow back from all the retail space and everything else that they sell in this location, and the office space and all that other stuff. So they could be gigantic. Oh, also, by the way, incredibly valuable. This is a central hub for the New York subways, not only the New York subways, but the ones that go out to Jersey and the ones that go over to Brooklyn and Queens as well. So it is probably the best location in Manhattan. It is the best location in Manhattan because the other major station is, well, there's Grand Central at 42nd Street. So let's say 42nd Street is just as good. But the other major station, Penn Station, which is not far from Macy's, but is a much grittier. It's a couple of blocks down is Penn Station. It's not nice over there. It's not a nice neighborhood. So this is a better location, and you have access to everything. All the trains and everything else goes through here. It's not nowhere near as crowded as Grand Central Station on 42nd Street, which is a nonstop traffic jam. And it's very accessible for the Lincoln Tunnel, also very important for New Jersey. So on the whole, you couldn't have a better spot or a more valuable spot in New York. So that's something they can work on and free and drop a lot to the bottom line. Why does that matter? Well, because you're talking about a company with a very, very low valuation, just $4.6 billion, and the company only makes $1 billion a year. So if they end up bringing in $200 million, $300 million in cash flow, that's an incredible boost to the bottom line. Okay, you look at them now and say they have a 5 P. What if the P is like 3? At some point, somebody's going to buy this thing. I don't mean the whole company. I mean, at some point, somebody's going to buy the stock and realize it should go up closer to 20. So I love these guys, and they are paying out. And obviously, it's very serviceable. They're paying out 150. And if we look at their cash flow, so see dividends paid 400. They're paying out 400 million in dividends, and they're still dropping free cash flow. Blah blah blah. There you go. Look, they're paying out after paying out 450 million in dividends. They're dropping $1 billion, 800 million, 500 million to the bottom line. Why are they dropping so much to the bottom line? Because there's a lot of depreciation and stuff in Macy's. So again, because of all the buildings they have, they depreciate a lot. So it's almost like a real estate play. People don't realize that, and they treat it like it's a retail operation, because most retail operations rent all their stores. Macy's owns all their stores because they're 100 years old. And again, the other thing is Macy's is very much like Sears, and the reason those Sears did terribly is because Eddie Lampert took all the money. He squeezed all the properties out of Sears and put it into his ESL Investments and his Seritage that he set up. He set up a company called Seritage, which the whole purpose of the company was to bleed off the assets from Sears. So they got all the prime real estate holdings that Sears has, and he let Sears go down the tubes. So the problem is people look at Macy's and go, oh my God, it's just like Sears, they're going to go bust. But if nobody steals the money, they're not going to go bust. And they don't have that situation like Sears did, where a venture capital guy came and took over the company. So I'm very gung-ho on this, and I think we will put it into our dividend portfolio. And if I wanted to look at a play for them, because I mean, that's a fat dividend. Not only is it a fat dividend, so $1.51 is a dividend. You're buying the stock for $15, and you can sell two, and it's got liquid options, which I always like. Look at this. You can get $3.25 at least for the $15 calls, and you can sell the $13 calls for $3.75. So you're talking about $3, $4, $7. You can knock $7 off 15, and you're going to get called away at 15 for an $8 gain. So we're in a dividend stock, and if we get called away at 15, we have 100+% gain, or I'm sorry, not 100+, a 90% gain on being called away. Our worst case scenario, we're in for net, what do we say? So we're in for net 8, and then if we get assigned more at 13, that's 21. Divided by 2 is 1050. So basically, our worst case scenario is we own the stock for 1050, 2 times the stock. But our net outlay of cash on 1,000 shares would only be $8,000. And we're collecting a dividend of $1.50. So we're collecting $1,500 in dividends. So in 2 years, for laying out $8,000, we're going to get $3,000 back in dividends, which is 40%, almost in dividends. And if we get called away at 15, if the stock does well, we're going to make another 90%. So that, if I had more faith that nothing bad was going to happen to them next year, and because of the debt overhang, you have to always worry about that, but this would be almost like a trade of the year. How ridiculous is that? So we have to add that to the dividend portfolio. It's just too freaking good not to do. And by the way, so that, now you compare that to the Canadian bank, to CM. It's like there's no comparison. I mean, this is just an incredible value. And it's highly unlikely to go lower. And even if it does go lower, we've got massive protection. It can go 33% lower, and we're only even. So that's the way we would get into this stock. And in fact, well, we're certainly going to do 1,000 shares, because 1,000 shares we can make 7,000 plus the $3,000 in dividends. So we can get $10,000 back on $8,000. It's 125%. And then the question is, should we buy 1,000 shares or 2,000 shares? And I don't really see any good reason not to buy 2,000 shares. So I think that's going to be our play. I think we're going to do this with 2,000 shares. Now, how much money is my margin on the 13 puts if I sell if I sell these puts for $350 and I sell 20 of them? Look at that buying power effect, 2,600 bucks. That is so worth it. We're going to collect $7,000, and that's fantastic. It's even margin efficient. No reason not to do this one. So that's a definite. We're going to officially do that in the dividend portfolio for sure. In fact, why don't I just write it up, because you guys, I think people like it when I write things up, so I write it up. Let's see. Oh, everybody's waiting for my comments. Torqued ourselves into owning M in the dividend portfolio. Buy 2,000 shares of M at $15, $30,000. Sell 20 $2022 $15 calls for the 2022, yeah, $15 calls for 3. See, somebody just got it for 325. I don't know. All right, let's say 3. Let's say 325. 3.25, $6,500. Sell 20 2022 $13 puts for 375, right? 375. 3.75, and that is $7,500, right? Yep. And that is, I always make mistakes, so I'm going to do it this way. 3123 minus 6500 minus 7500. Nope, what'd I do? 30 minus 7500 minus 6500. So that's net $16,000 on the $30,000 spread if called away at 15 flat for a $14,000 profit, and 14 divided by 16, 87.5%. Profit and dividends are 151 for 3,000. 20 per year, or 6,040 into 2 years, and that is another $6,040 divided by 16,000. 37.75. 37.75%. Very nice returns, and only net $10.50 per share if So 30% downside cushion 2. Okay. So let's see, we're going to now bold it and indent it and make it blue to call everybody's attention to it. And we're going to take the picture, not CM, but M. Where was I? Here we go. All right, very nice. Make sure it publishes, and we're also, there you go, lovely. So now everybody's got it. Penn is only one avenue over, Philton says. Okay, thanks. Can play oil through USL. I don't want to play oil long. I want to play gasoline long. Gasoline is a more reliable long into a holiday weekend. So with Thanksgiving coming up, is very likely that there will be some spike in demand for gasoline. So it's not about oil. Oil, we had a definite surplus. We had a definite build in oil stocks. Gasoline, though, which actually fell now, failed the 161.5. So now it's a loss there, and hopefully stopped out if by this time. So it's a loss now, and we wouldn't play it again unless it gets over 162 because we've now decided that line's not reliable. And the next place we want to play is 160, where I play much more aggressively. All right, so Ken says Penn is only one avenue over, so a block down is Penn Station for Macy's. And Robin says, I sold the M2021 $30 put. Do I roll at the bottom or roll closer to the expiration? Aha. Well, that depends. There's no sort of rule about that. Well, the question is, do you think that M has bottomed out? So you said you sold the January 21 $30 put, which is now a lot of money, which is now $16. What I would do, if you can, is I would, first of all, it depends what you sold it for. That's one question. Do they have any premium in it is the main question you want to ask. So in other words, the $30 put is $16. It's only got $1 premium, and that's $14. So you're not gaining anything by waiting for expiration. You have no premium to gain. What you want to do is pick a more realistic target. So so in other words, if you were to roll the 30s down to, these are going to be $8. The 2022 20s are going to be $8. If you were to roll the 30s to 2 times the 20s, you would then, it would be a more or less even roll. You actually pick up a little bit of money maybe, but you roll to the 20s. Now you're obligated to buy twice as many 20s. But if you think about it, right now you're obligated to buy 1 for 30. And after the roll, you'd be obligated to buy 2 for 20. But here your net is 12, and there your net is 14. So you're obligated, instead of buying 100 shares for $14, you have to buy 200 shares for $12. It's a more realistic target for you to break even. And obviously you're not breaking even because you've been selling for that much. But then the next year in 2023, you could then roll to the 15s, because right now you could roll, if you were at the 20s now, okay, you would be able to roll those to like the 17s for $1, right? So let's see, these are $7.25, and these are, let's say $5.80. So it would cost you about $1.20 to roll them $3 lower. That's reasonable. At least you can do that. And if you have 2 more years to roll or a longer period, you can do that also. So it's a question of whether you think it's important to buy it for time or to move lower. But if you can go $5 lower and you're starting at 20, and that means if you can do that every year, go $5 lower for $1.20, that means you go to zero in 3 years. So that means instead of costing you $7 or $8 to get out of the position, you can hopefully get out for about $3 or $4. So you're putting yourself in a place where it's going to be a lot easier for you to win, but you are obligating yourself to own more Macy's stock. Okay. On the other hand, keeping in mind that you are already significantly down on the position, you could just look at it the other way and say, why don't you scrap the whole thing and pick up the position that we were just talking about? Because that position, in other words, you look at what we just did, which was whatever the heck it was. Like I said, this one is going to make $16,000 on the $30,000 spread. We called away with a $14,000 profit, and plus the dividends of $6,000. So we're going to make $20,000 on this position from our $16,000 base, 125%. It's funny how it doesn't amount to 125% if you add these two things up. So maybe I did something wrong. But anyway, we're gonna make the $14,000 here on the $30,000 spread. If Macy's just hits 15, right now you need it to hit 30. So yeah, you have a loss, and if you lost, well, it doesn't matter what you lost. But if you're down $10,000, you can make money back by doing whatever portion you need of this spread, which will make $20,000. So you can do half of this and make $10,000 back under much more favorable conditions, because you'd be significantly reducing your risk of exposure with a $13 puts. Yes, you'd have to put cash into the position, but at least you've got a clear path to getting your money back at $15 instead of needing 30 and certainly even 20. You don't even need 20 anymore. You just need to hold 15. So that's what you want to consider. It's saying, is this really a good place? Just because you started in a position, it's not always a good place to keep your money. And also, by the way, when you're rolling, you really have to consider doing a roll when the premium of the position you're in is down below a third, let's say, as a rule of thumb. So in other words, when your position is less than 1/3 premium, it starts becoming useless to you, and you're not going to get a good roll if you don't do it then. If you wait any longer, like now you have pretty much zero premium. If you wait that long, you don't have any good rolls to go to, because even the things you want to roll to have no premium. Whereas if you have something, and let's take a look on Macy's. If you had a call that had a premium of some kind, like the 15s at 360, 375. So at 375, the 15s are net 1125, right? Yeah, 1125. So net 1125 here. Macy's is at 15, so obviously there's plenty of premium. I'm trying to find one that doesn't have that much but has more. All right, the 7s, I guess, are a good example. Okay, yeah, the 7s are okay. I mean, sorry, the 7s are 20. The short 20s are $7.25. Okay, so therefore your net here is $12.75. That's good. There you go. So it's $12.75, and that means you have $2.25 in premium on this position. And $2.25 is roughly 1/3 of the price of the call. So this is right when you should be rolling it. Why is that? Because where can I roll the 20s to? Well, I can roll the 20s to the 17s, which are just about $6, and I would pay $125 out of pocket. So of whatever I collected, I would give up $125 out of pocket, but I'm rolling down $3 in strike, and I'm barely out of the money anymore without having to double down and do anything else. And if you can roll down $3 every year for $1.25, let's say you originally collected $4 for the short calls. If you can roll 3 times before you use up your $4, that means you can roll $9 lower in strike from where you started. So in that example, that means that you would have been, had you just rolled on time, you would have eventually been able to roll your 30s down to the 20s in a couple of years without taking money out of pocket other than the money you already collected for the short puts. So that's why it's critical to take an action. You don't want to wait until it's too late, as it is right now for you, because you have no premium. You have nothing to bargain with. So when you buy back the option, you're already in a bad position, and even the call that you reasonably want to roll to is running out of premium. That's where your problem comes in, because even the call you want to roll to doesn't have a lot of premium. So how are you going to win? The only way you can win is by the stock making the whole move for you. You're 100% dependent on the stock. Whereas the whole point of selling the puts is you shouldn't be dependent on the stock. Your time is going to kill the premium, and that's where you're going to make your money. So once that's no longer true, then the position doesn't make sense to hold anymore. That's when you need to take action. Whoa, the Dow's up 80 points. Oh, because Powell's talking. Powell says not thinking about raising rates right now. Doesn't seem to matter. I forgot he was talking. All right, well, I'm out of voice, so I'm not gonna sit here for this whole thing, but for whatever reason, whatever Powell's saying is certainly boosting the market considerably. And like I said earlier, though, it's like, hey, if the market's going to keep going up, we may as well play. Look, oh, look at it. So as soon as he started speaking, look at this boost. So he's definitely making the right kind of noises. But that happens a lot, though. I still think in the long run, you got to go by what the statement says, and I don't think it's all that positive. But we'll see. We'll see. By the way, watch Brent if it holds 60 and oil if it holds 55. Those are bullish signs for the gasoline. But if they're failing it, then absolutely you got to wait here and wait till we see some kind of proper turnaround. So sorry that first trade didn't work out, but that's why we wanted to have really tight stops, because we don't want to lose any money here. We're hoping we hit to 160, and that was just in case it didn't. It was just in case it didn't fall, but it is falling, and so now we're looking more like the 160 line. Hopefully that's going to hold. All right, and other than that, we'll see if the Macy's trade works out, and we'll do this all. Oh, I'm sorry, next week we are not having a webinar because I'm going to be on a boat. So we will come back, but everything will be back to normal on the 11th. No, that can't be right. The 13th. So we'll be back to normal on the 13th. All right. Actually, I won't be on a boat. I'll be getting off the boat. I have a 4-day. Wait, when do I leave? Saturday. Saturday, 1 night, 2 night, 3 night, 4 night. Okay, yeah. So we come in that day, but I'm not getting on a boat and doing I'm not getting off the boat and doing a webinar. So we're gonna skip next week and we'll do it again next week. Okay, folks. So have a great day. I'm glad everybody. I hope everybody got some lessons in here, and we can continue obviously these conversations in chat. All right. Take care, everybody. Have a good day.